Hi everyone! Last week, shock waves rippled through global markets after the collapse of the largest banks in the US. Silicon Valley Bank faced a sudden bank run and capital crisis. Following its failure, investors rushed to sell off risk assets. They are now making decisions taking into account the risk of the crisis in the banking sector. They are constantly monitoring updates on the financial sector and the government's efforts to boost confidence in it. Apart from that, they are looking forward to the Fed meeting. Despite the woes and uncertainty in the banking industry, the main stock indices managed to end last week with gains. They kicked off the new one with growth as well. This week, U.S. home sales for February, the Chicago Fed National Activity Index, durable goods orders, as well as manufacturing and services PMI indices are on top. Reports published last week highlighted the need to stick to aggressive tightening. However, given the headwinds in the banking sector, the Fed could adjust its monetary policy. Watch our video till the end and find out more interesting details. Let's start. Concerns of the largest U.S. bank failures since 2008 financial crisis subsided slightly last week. The stock market was able to stabilize after several days of turmoil. However, speculators remain cautious. They fear the domino effect in the banking sector, as well as the likelihood of further tightening at such a difficult time. Investors are still nervous about the state of the global financial system even after the takeover of Credit Suisse by UBS and the actions of the world's central banks to increase dollar liquidity. In a deal brokered by the Swiss government, Switzerland's biggest bank, UBS, agreed to buy Credit Suisse to stem the market panic. This measure was meant to prevent an outflow of customers and a sell-off of stocks and bonds. Meanwhile, the Fed and 5 other central banks announced a coordinated effort to boost liquidity in US dollar swap arrangements to maintain stability in the global financial system. Shares of the largest U.S. banks recovered. Citigroup's stock advanced by 1.5%. Goldman Sachs shares added 2.6%. JP Morgan stock climbed by 1.6%. And Bank of America shares grew by 1.3%. Meanwhile, shares of First Republic Bank plunged by another 19%. The drop has already exceeded 80%. It happened after S&P downgraded the bank's rating to junk and stated that the recent cash injections of $30 billion may not be enough to solve its liquidity problems. Here is dilemma. The largest lenders are rushing to rescue their bank while rating agencies are making things only worse. Moody's also downgraded First Republic to junk status. Market stress indicators still signal the continuation of the banking crisis. Despite the short-term relief after the news of financial assistance for banks, volatility in markets is increasing. However, the indicators have not exceeded the levels logged in 2020. This is why uncertainty over U.S. banks remains high. As usual, there are companies that managed to generate profits amid the situation. Last week, the turmoil in the banking sector helped tech giants earn $500 billion. Microsoft and Alphabet shares jumped by more than 12%. The market sentiment is somewhat mixed. Speculators are hesitant to pick up a trend. Therefore, stock indices are fluctuating in a wide range. The Dow changed slightly last week. Its price swing was just 0.4%. However, the situation may change dramatically after the Fed meeting on Wednesday. Usually, traders are more or less aware of what to expect from the regulator, but not this time. The latest events may force the Fed to adjust its stance. However, the situation in the banking sector did not affect the ECB's key rate decision last week. The report on the U.S. Consumer Price Index released last week once again reminded traders that the Fed's main priority now is inflation. The central bank needs to push down inflation to cement financial stability. The CPI fell to 6% in February, meeting expectations. However, the core consumer price index rose slightly more than expected on a monthly basis. For this reason, market participants are confused. Where to find new clues? Should they analyze fresh macro stats or pay more attention to the ailing banking sector? Analysts assume that economic reports are not relevant now. They are also confident that the central bank will hike the key rate. Yet some economists point to the fact that the Fed could take a pause in the tightening cycle. Some of them are betting on rate cuts in the near future. However, 83% of traders have factored in a 25 basis point rate increase in the March meeting. The stock market is likely to be volatile for some time. Sometimes traders will be optimistic about the situation. However, should any negative factors arise, pessimism will prevail. There is also other worrying news. Donald Trump said he expects to be arrested on Tuesday as New York prosecutors consider charges over a harsh money payment. He called on his supporters to protest. This may fuel volatility, undermining risk appetite. The S&P climbed by 1.5% last week. The bulls are rather weak. They are still unable to push the price above 4,000. However, they need to do so to facilitate a further upward movement. The important support area is located at 3,800 to 3,760. If sellers manage to push the S&P below 3,800, a deeper downward movement may take place. The next potential target may be at the level of 3,630 and then 3,490, the low of October 2022. Jerome Powell's speech at a press conference should provide more clues about the current market situation. If he says that the Fed could soon end monetary tightening, sentiment may improve. Yet there are also many other factors that may affect market sentiment. Besides, investors suppose that the Fed will not abandon its hawkish stance. The watchdog has more than once said that its main priority is to cap soaring inflation. What's more, the banking crisis was hardly a surprise for the Fed. The regulator was certainly aware of the huge losses of banks. Powell has repeatedly warned that the actions of the central bank could inflict pain. So this will be the price for curbing inflation. The biggest gainer last week was the heavy-tech NASDAQ 100. It jumped by 4.3%, although it also faced bearish pressure. The banking crisis persists, making stocks extremely volatile. This is why a 25 basis point rate hike is the golden mean. It will enable the Fed to prevent a new surge in inflation and lower the risk of bank runs. This week could be decisive. Investors will get more clues about the prospects of the banking sector. Central banks may mitigate their crisis through more money injections. It will also help ease the panic. However, sooner or later it will wane anyway, so the situation differs markedly from the 2008 crisis given the market conditions and the factors that triggered bank failures. Yet the central bank is sure to take notice of these events. Therefore, it may revise its monetary policy stance. That is all for now. Hit the subscribe button and stay up to date with the latest market news. See you!